Hi, it's Mike and Alan once again with the Gold Silver Show. Alan, what have you got for me?
Hey, Mike. Yeah, there's been a lot of talk lately about revaluing the price of gold, possibly up to the current market price or possibly even beyond that. So in this video, I want to go through why the government might do that and what the implications are for all of us, basically, the price of gold and beyond. So first, we have this article from Forbes. The Treasury is sitting on a $750 billion gold hoard, officially valued at only $11 billion. So it could certainly increase the value of that. Soaring gold prices and a $37 trillion national debt have revived debate over revaluing gold reserves. A new Federal Reserve note explores how other nations have raised funds through revaluation. So let's actually look at that Federal Reserve note.
I'm surprised they called it a new Federal Reserve note. You mean they're talking about an article on the Federal Reserve's website, right?
Yeah, it's not a new Federal Reserve note like this one, right? Yeah.
Okay.
Yeah, this is a document published on the web.
Yeah.
So
Okay.
This came out August 1st. It said official reserve valuations, the international experience. So this is the Federal Reserve acknowledging that there's precedent for this, okay? So with public debt at high levels, some governments, and we're going to see in a second that there's actually 5 of them, some governments have begun to explore financing additional expenditures without raising taxes, while also not increasing public debt outstanding. Okay, so no additional debt and no new taxes. Interesting. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the US and Belgium recently. Okay, so for the US in particular, this would involve revaluing the government's 261 million troy ounces of gold, which is the largest gold reserve globally, from a statutory price of 42.22222222 per troy ounce to current market prices, which stand around 3,300 per troy ounce. Okay, so it's basically just a book entry where you say, abracadabra, the gold we have, instead of being worth this magical price of $42 per ounce, you actually reflect the actual market price. And on that difference, the Treasury gets all those dollars free and clear and can spend them. So over the past 30 years, only 5 countries have actually done this, but that's more than 0. So 5 of them have done it. Germany, Italy, Lebanon, Curacao and St. Martin, and South Africa. So why would they do this? Well, central governments have drawn on revaluation proceeds to retire existing debts, often in exceptional fiscal circumstances. So is the US in an exceptional fiscal circumstance? I would say yes.
Yes, absolutely. And there's a couple of things I want to point out real quick here. The government, U.S. government, has 261.5 million ounces. There's 330 million people. And so there's less than 1 ounce per person. So if you don't have your ounce yet, you should probably get one.
That's right. Get one.
Yeah. And then 3,300. I mean, this is changing every day. It would be ridiculous to pick like 3,300. So, and then Curacao and St. Martin, they actually, I believe, when we took the data on what countries hold the most gold, we were the only ones to take it and divide that by the populations and see which countries have the most gold per capita, per person. And I believe Curacao and St. Martin came in at the top, didn't they? They were way up there.
You could be right. That does sound familiar. Yeah. I don't remember if they were number 1, but they were certainly very high up.
Right. And so if they didn't have a high levels of debt to begin with, then that would have been easy for them to do. And it wouldn't have been something that would create a global shock to the monetary system. So, okay, go ahead. I'm sorry.
Exactly. Oh, it's all good. It's all good. So just as a final example here, Lebanon's debt-to-GDP ratio continued to increase even after revaluation proceeds were used to retire some existing debts. So anyways, debt-to-GDP ratio is part of the discussion. That's why a government would do this, is to lower their debt-to-GDP ratio. So what I want to do is actually show you guys an Excel model that I built to sort of ask the question of, if you wanted to lower your debt to GDP ratio a certain amount, how high would you have to revalue gold in order to achieve that effect? Okay, so I built a very simple model that I want to show you guys. But right before we go to Excel, I just want to present the numbers for debt and GDP and debt to GDP on the Federal Reserve website. That way we all have a sense of what's going on. So this is total public debt. And you can see it just goes up and up and up and up. And it's been going up pretty quickly. We're up around $36 trillion right now. Okay, so debt goes up. GDP also goes up and up and up and up. We have some recessions, obviously, COVID and so forth. It's been going up a lot lately. We're up around 30 trillion. So 36 trillion, 30 trillion. And this is debt to GDP. You just divide the two together. So currently debt divided by GDP is up at 120%. So this is very high. In just a minute, we'll put it in perspective with other nations and what is a safe level, what is a dangerous level. We'll look at that in a moment. But you can see historically, debt to GDP in the US was low in the 30s for a long time, 40s, 50s.
Okay. In the 1970s and 80s, it was down at 30%.
Yeah, exactly.
Okay. Yeah. And then the 70s and 80s percent occurred in, yeah. Okay.
Yeah,
sorry.
Yeah, no, you're good. Yeah.
So before the global financial crisis, we're talking about 61, 62, 63%, until Ben Bernanke basically changed the way that currency is created in the United States and started QE. And that's where QE created a market for a whole lot more treasuries. And we were able, while GDP was shrinking during that recession there, they were creating currency like crazy through QE.
Exactly.
Yeah.
By the end of the recession, up to 82% debt to GDP. Shortly thereafter, 90%. I mean, yeah, and then eventually it leveled off around 100%, but it didn't come back down to these long-term sustainable levels. Instead, we had COVID and we went up to over 130%. Yikes. And we're still not bringing it down, like 120%. So yeah, very, very high debt to GDP. And the interest payment is really the killer here, because when you're spending, GDP is the size of the economy, you're going to collect a certain amount of that in taxes. But then if you have to spend all of it on interest, you can't do anything else. So that's really the problem here, is that the interest payment has absolutely exploded from the COVID era of only $500 billion to now over $1 trillion. So it's more than doubled in just 5 years. I mean, this is insane. You have to solve this problem immediately.
Yep.
Yeah. So last thing I want to say here before we go to our Excel model is that the average interest rate is about 3.33%. It's in the low threes. It's trending upwards. So a few years ago, it was only about 1.5%, 1.6%, and it's trending up. It's in the low threes now, but it is going higher. So
it's more than doubled though. 1.5%. Yeah. 1.6. So it's more than doubled. And the thing is that we always have to roll over. The old treasuries mature and we've got to refi, basically. It's just like refinancing your home. You got to take out another mortgage. And so that's what we do every week. We're taking out another mortgage on the United States of America. And right now, the rates are much higher than the debt that we're retiring. The debt that we are retiring was at very low rates. And so that's the reason this is trending up. Yeah.
Exactly. So keep that in mind, low 3%, because now we're going to go to Excel and we're going to explore these exact questions. So there's really two questions we're exploring in Excel. The first is, how low of a debt to GDP ratio do we need to get to in order to be sustainable? And number two, how high of a gold price do we need to get in order to achieve that particular debt to GDP ratio? So for the first question, there's actually a paper published by the World Bank back in 2010. So this is kind of an older paper, but they explored the first question. This paper is Finding the Tipping Point When Sovereign Debt Turns Bad. And in the abstract, they basically said public debt has surged during the current global economic crisis, right, the 2008 crisis, and is expected to increase further. This development has raised concerns whether public debt is starting to hit levels where it might negatively affect economic growth. Does such a tipping point in public debt exist? How severe would the impact of public debt be on growth beyond this threshold? What happens if debt stays above this threshold for an extended period of time? Okay, we're not going to go too far into the weeds on all that stuff, but the point is they did come up with a threshold. So the present study addresses these questions with the help of threshold estimations based on a yearly data set of 101 developing and developed economies. Okay, so over 100 countries, that's half the world, and it spanned a period from 1980 to 2008, so 28 years. The estimations establish a threshold of 77% public debt to GDP. As a reminder, we're currently at 120%, and they say 77 is sustainable. Okay, if debt is above this threshold, each additional percentage point of debt basically costs a certain amount of real growth. So you're not going to be able to grow your economy well when all of your payments are going towards debt. Big surprise. The effect is even more pronounced in emerging markets where the threshold is 64% debt to GDP. Okay, so depending on what type of country you are and what type of economy you have, this threshold might be different, could be higher or lower, fine. We're going to look at some of these numbers. So remember 77, remember 64. And there's one other number to remember from this paper. Reinhardt and Rogoff answered that question of does a tipping point exist? And they said yes. And they used histograms from 44 countries, and they found a threshold of 90%. So then we've got three numbers, 64, 77, and 90. Okay? So what does this mean? Well, basically what they're concluding from their paper is the same thing, Mike, that you and I came up with for the book, which is basically that at a certain point, taking on more debt does not help you grow the economy at all. And this is basically the chart we put together where we're measuring the change in GDP over a 5-year window and comparing that to the change in debt over a 5-year window. And basically, when this number is above 1, what this blue line, when it's above 1, that means that the government can take on an extra $1 of debt and get $2 or $3 or $4 worth of extra GDP. That seems like a good bargain.
Or 6 or 7 or 8, like it used to be right after World War II.
Exactly, or 6 or 7 or 8. Right? But above
there was
1.
also demographics to back that up. You know, you had a young population. You had all the soldiers returning from the war, and you were coming from very low. People were very debt averse, so you didn't have. We actually had a lot of debt left over from the war, though. But in the private economy, people were debt averse because of the Great Depression that had just before the war. So growing our way out of debt, growing the GDP much faster than the debt. Yeah. And then, so one of the things I want to say on this is you see where it goes below the zero line is right where Ben Bernanke introduced QE, and we changed the method of how currency is created in the United States. And this has gotten us to a point where no matter how much we borrow, this is just digging the pit deeper. We can no longer grow our way to prosperity. We can't grow our way out of the debt any longer. And then when you add the bad demographics of having a baby boom generation that is currently facing retirement, and like me, I didn't retire at 65. I'm going to be 70 soon, and I have no intention of retiring right away. I sort of like what I'm doing, but there's going to come a day where a lot of these baby boomers are just no longer able to work. So it makes this even worse, is my point.
Exactly. And we're already at that point, at that place, just to drive the point home, where every time the government borrows an extra $1, we're only getting 50 cents back worth of GDP growth. I mean, that's a terrible decision. And now we passed the big bad boondoggle bill. That's right. So we have to solve this problem. We absolutely have to solve this problem. And to the point of the video, gold revaluation is potentially one way to do it, but we're about to see how ridiculous the numbers would have to be. And so it certainly is not going to be a panacea. It's going to be part of a much larger plan. So here's basically what we're looking at. Very simple model here. We're looking at debt to GDP. So right now it's about 119%. And of course, we calculate that by taking the total debt and dividing it by total GDP. Okay, very simple. Now, if we want to lower debt to GDP, let's say from 119 to 116, okay, obviously we would have to retire some of the debt. So we just have to pay it off. So we would subtract that from the outstanding amount and then divide that by GDP. Okay, so if we wanted to get to a debt to GDP ratio of 116%, we would retire about $1 trillion worth of debt. But in order to come up with all that currency, we would have to revalue our 261 million ounces of gold up to $3,981 per ounce. So
4,000. And it doesn't even make a dent. It takes it from 119 to 116.
119 to 160. Yes. And that's higher than today's price of gold, right?
Right.
So, and that doesn't even make a dent. Remember those numbers we were looking at before, 90%, 77%, 64%. Okay. We're still at 116.
And then where it bottomed during the Reagan administration of about 30%, or just before the Reagan administration.
Yeah.
Yeah. So let's take a look at all those. That's interesting.
Let's see if we go down to 110%. Okay. That's already $11,000 an ounce. That's already
Which would be an enormous shock to the world monetary system, and it could cause, really bad ramifications. But I want to tell people here that this is entirely possible. The way gold is great. I've often said gold standards suck. So a gold standard is not a good thing. Here's the way you can make gold $11,000 an ounce or any price that you want. The government has to stand ready to buy or sell gold in unlimited quantities at a specific price. And nobody is going to be buying gold from them suddenly at $11,000 an ounce when the free market price was just $3,300 an ounce. So basically, the U.S. government, if they want to raise it to $11,000 an ounce or whatever the price target is, they buy gold from mining companies and anybody that wants to sell them gold at whatever price they want gold to be at. And when they buy it, they print the IOU, the currency that backs it up. That's a gold standard. It's a scam. They just say the price is going to be this, and people bring them the gold at this new inflated price, and they print up a receipt for the gold that is the currency that backs and the gold backs it. The gold they just bought, it's a sleight of hand trick. So anyway, go ahead. I'm sorry I interrupted.
No, it's all good. And just to point out, that $11,000 an ounce price only lowers debt to GDP to 110%. I mean, I would hesitate to even call that a dent. I mean, it's like not. So if you take it down to 100%, you're talking $22,000 an ounce gold. So these are already bananas numbers. Like it's like nonsensical. And so it's clear to me so far. I mean, we have more numbers to put here, but like it's clear to me so far that gold revaluation is not going to solve the fiscal problems of the U.S. Not even close. They can't do this. It's not going to work. But if they wanted to go all the way to 90% debt to GDP just using this one tactic, that's a $34,000 an ounce gold price.
Wow.
I mean,
70%. What was the other one?
77, 49,000, and 64. This was developing countries, $64,000 an ounce. So,
and this is 62, 61. That's where we were just before the global financial crisis.
Oh yeah, this was what we were in 2007.
$66,000 an ounce is where gold would have to be to take us back to the debt to GDP before Ben Bernanke changed the way we create currency in this country and we introduced QE. Wow. Okay. Yeah. So what happens if we take it down to the Reagan administration, pre-Reagan administration, 30% of GDP?
31%. I got to fix my column width here. It's too big a number. Oh my goodness. $100,000.
Oh my God. Okay. You know what this says to me is that we really missed there was a period of time when gold was in a bubble in the late 70s, early 90s, where we could have gone back on a gold standard. I wish we had just gone back onto gold, but basically gold covered all base currency at the time. The value of gold when it was over $400 an ounce or something was greater. The value of the gold the U.S. holds was greater than the value of all of the currency outstanding. And so they could have made the paper currency. Now, this is this is crazy. Nixon put us in a box, and I don't see a way out of this. I can't figure one out. Sorry, go ahead.
Yeah, no, I agree with you. I mean, this isn't going to do it, right? They're not going to revalue gold like this. They might take it to a much smaller version of what we just showed, but this would be absurd. They're not going to do it. But just for anyone curious, there is a chart here of all the possible revaluation targets and the resulting debt to GDP ratio. So if you did want to, let's say, come out with a debt to GDP ratio of 90%, you follow this up and follow it over, and then you'd have about a $34,000 an ounce gold price. That's what we saw just a moment ago. So these numbers are ridiculous, obviously. And you can see it
right.
today.
They bring the global financial system to its knees.
Yeah, exactly. And if they only did something small, let's say they revalue it up to 3,300 or whatever the current market price is, that's a low number down here. I mean, doesn't
even make a dent.
They're barely even moving it from 120 to 116. I mean, there's no point. There's no point to doing that.
Right.
Doesn't solve the problem. So that's debt to GDP. The other way they could come at this is looking at the specific interest payment. So we mentioned back on the Treasury website or the Federal Reserve website that interest payments are now about 1.1 trillion every year. I built this very similar model looking at the interest payment. So currently it's about $1.1 trillion per year. And the average interest rate is in the low 3%, it's about 3.1, 3.2%. And suppose that the government wanted to get that interest payment down to a manageable number, right? They want to go after that. Let's say they want to lower it from 1.13 trillion just to 1.1, which is like basically nothing. Okay. So to lower it hardly anything at all, the implied price of gold is already $3,700 higher than market value.
Wow.
That's nuts. If we want to go a little bit lower than this, let's say from 1.1 trillion just to 1 trillion. That's already
what happens when you get to pre-COVID levels? What was that was 100. That was 500.
Pre-COVID was about half this.
Yeah, half a trillion.
So it was about half a trillion, $77,000 an ounce gold to lower the interest payment that much. I mean, this is crazy.
It is crazy. The world has gone insane.
And it's partly because the interest rate has gone up, like kind of permanently, you might say. I mean, obviously the Fed could cut rates and bring it back down again, but it takes a while to roll it all over. This is nuts. I don't see a way out. Obviously, they're not going to do this either. They're not going to take gold to 77,000 just to lower their interest payment, just to cut it in half. It's just not going to work.
And what happens if you take interest down to zero? Because interest is a waste of our tax dollars.
If you take interest down to zero, hang on, got to make this bigger again. Must be over 100,000. Yeah, $138,000 an ounce.
Wow.
It's just, the ridiculousness of these numbers shows you how difficult of a financial position the U.S. is in. This is clearly not a solution.
Right.
Well, for anyone who wants to see this chart, it's very similar to the one before. Currently, the interest payment is up near 1.2 trillion. If they wanted to lower it to pre-COVID levels, like about 600 billion, that's what we saw before. That's like $64,000 an ounce gold. I mean, these are crazy numbers. In order to reduce this interest payment meaningfully, the price of gold is just a bananas number.
Yep. Right. So it's the only way that this works out. It doesn't work out. We go through some sort of implosion.
And that brings us to the meme of the day from Carl Bitcoin Manger. Damn, bought this shit coin back in 2013 and I'm down 50%.
Wow. Well, and it's true. So I want to thank you so much for all of that great analysis and those spreadsheets that just, there was the Magambo guru, Richard Doty, very entertaining, probably the most entertaining man in economics. And he had this saying, "We are freaking doomed." I just don't see any way out of this other than complete implosion of the monetary system. They can't grow their way out of it. It's just not possible. So thank you so much, Alan.
My pleasure, Mike. And thank you everyone for watching. See you in the next one.
Bye.
Invest and earn up to $2,000 in bonus silver at GoldSilver.com. It's easy. Step 1. Open any GoldSilver storage account excluding IRAs. Step 2. Purchase your precious metals. Step 3. Get up to $2,000 in bonus silver dropped straight into your vault. Visit GoldSilver.com/free silver to claim your silver.